Welcome back to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined the Equity Mates community, a massive welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We have a jam-packed schedule. We are going to cover how you can analyze any stock in 30 seconds.
Shit.
Yeah, get ready for that. And then we've got a Pimp My Portfolio. Charlie Viola of Viola Private Wealth is returning. But first of all, as always, we like to start with the news of the day. What's making headlines?
News and markets.
Well, Ren, there's plenty of news making headlines. Let's start with the latest inflation figures that have come through here in Australia. The news is pretty good.
2.8%. We're
Yes.
back within target. That is the big story for the September quarter, 12 months to September, 2.8%.
The headline?
For CPI, yeah.
Yes, 2.8%.
Now,
So,
the Reserve Bank's target is 2 to 3%.
yeah.
So, in the US, the Federal Reserve's target is sub 2. But here in Australia, 2 to 3%, we're in target. Surely that means interest rates are coming
Come on,
down.
Michelle. Come on. No, I think
No.
No. The follow-up stories to this is that the expected rate cuts keep getting pushed further and further out. The latest I've seen is market expectation is that we actually won't get one until post-federal election next year.
Okay, and when's that?
May?
Well, we don't know
Question
yet. It hasn't
mark?
been called. Yeah.
Should sometime next year.
Yeah. So I think that there's a couple of things why we shouldn't expect a rate rise straight off the back. Like, this is good news. Let's start there.
Yeah.
But the question is, how sustainable is this inflation print? There's a bunch of cost of living measures in the system. Queensland 50-cent fares for public transport, federal government energy rebates. There are state government energy rebates in some states. There's like a lot of cost of living relief, which is potentially temporary. So they want to see a sustainable inflation level in the target. The other thing that has been called out is Christmas. So we're about to enter the Christmas spending season, and the consumer has held up okay so far. Like, obviously, people are finding it tough, but on an economy-wide level, consumer spending has held up okay. And so the question is, if consumers are spending over Christmas, is that going to have an inflationary effect?
So here's the thing, guys. If you want a rate cut, if you're pleading with the RBA for a rate cut, call to arms. No Christmas presents this year. Don't spend on Christmas. Don't worry about it. Agree with your family and friends. Our Christmas present is going to be a rate cut.
Yeah. I didn't get you a present because I am going to have a rate cut in February.
Yes, I'm delivering a rate cut, so suck it.
Yeah. Santa, the only thing I want to see down the chimney is a cheaper rate on my mortgage.
Exactly. Good. I'm glad we've sorted that.
Yeah, so good news with a caveat, obviously, and it will be a watch this space, I think.
Nice. A few other notable things that have come across the news desk this week. Dear old Woolworths can continue to feel the heat. The stock is down 6% after their most recent earnings report from the newest CEO, or their new CEO, Amanda Bardwell. Brad Banducci has passed the reins.
Yes.
And Amanda is now in charge. And unfortunately, it wasn't good news.
Yeah, so they updated the market and they reduced their profit guidance for the full year, a bit lower than they had originally guided. And Amanda also said, quote, "Looking ahead, we expect customers to remain extremely value conscious with cost of living pressures to continue for the remainder of F25. So look, F25, we're a quarter of the way through it already. So like, that's not looking out that far, but the market didn't like the idea that the consumer's feeling the pinch, and Woolworths' profit will probably fall will be lower than expected as a result.
Yeah.
So it's not catastrophic, but
No.
it's just a sign that the consumer is feeling the pinch.
Yeah. Over to the States, where a recently listed social media site, I guess, Reddit, they have reported an increase in daily active users by 47% year on year to 97.2 million daily active users.
Yeah, daily active
Yeah,
users. It's
crazy.
wild, yeah.
They've also come out with strong revenue growth numbers, up 68% to $348 million. And of course, the stock jumped on the news, up 40%.
Yeah, up 40%. Pretty wild. Speaking of companies that are in for a pretty wild ride, Zip,
Yes.
the Aussie stock that could, is so back. It reported its Q1 numbers. Transactions globally were up 23%, but in the US specifically, where this story is playing out in the most interesting way, transactions were up 43%. Profit globally was up more than 200%. But Bryce, as I list off percentages, here's the one that matters. In the past 12 months, Zip's share price is up 922%.
Even higher.
Well, that was at time that I pulled these numbers.
Yeah,
Yeah, what is that, 940 now or something?
Even higher.
Oh, is it 10 bag?
It's 978.
Oh.
It's crazy. And we have, I'm kicking myself that
Everyone's
this was so obvious.
everyone's kicking themselves
I
they didn't
know.
buy it. It wasn't that obvious at the time. Like Zip was seen
I reckon you could have
when it was 40 cents.
6 months ago.
When it was 40 cents, everyone was like, it's down and out. But yeah, you're right.
6
When it
months
started
ago,
to
when it
rebound.
started turning, yeah. Like markets love a turnaround story of 2 or 3 quarters of profit growth, revenue growth, turning
Well, it
things
became
around.
profitable in the past 12 months. That's the thing. Yeah.
So anyway, congratulations, Zip. Well done to Larry and the team. Up almost a 10 bagger in 12 months.
Yeah, I know. Wild. Well done to people who bought Zip at 40 cents.
Yeah,
Like
fair
that
call.
is a
Fair call.
that is a good investing story. Like
Fair call.
you've earned your money taking that risk.
Yes.
Then. Yeah.
To keep the good times rolling as well, Ren, Bitcoin is at all-time highs.
Yeah. No. It's almost
Almost.
at all-time highs. Between when we record this and when we release, my bold prediction is it will cross all-time highs.
Okay.
So for context, all-time high for Bitcoin, $73,750 in March 2024. Since March, it fell more than 20%, but now it's up again more than 35% since early September. It crossed 73,000. It's so close.
Yeah, it's so close.
Yeah.
Looking at the chart, it almost looks like it is now. But anyway, if 73 is the number,
73,750 is
Wow, okay.
all-time highs. It's up like 300% in the past 2 years.
yeah.
So full credit to
Full
Bitcoin.
credit to Bitcoin.
Honestly, this thing just keeps coming.
I know it does. It does. Anyway, if you're listening, Crypto Curious and the team at Bamboo, I have a bet with them. They reckoned it was going to hit 120 USD by the end of the year.
120,000 USD, and you said no.
And I said no.
And we spoke to
And
Tracy
that's going
recently.
against my interests because I am invested. But I'd love to see it. But yes, we spoke to Tracy recently, and she's very high conviction.
Yeah. Not on the podcast, just privately, and she
Yes.
still thinks that there's a chance that she wins this bet. So
Wow.
I think as crypto comes back, you're going to hear it more and more in the news. It's going to cross all-time highs, probably. I don't want to say it's guaranteed, but you can just see the cycle picking up again, and just be ready for the noise. But I think Crypto Curious is a great place to go to keep up to date and maybe avoid some of the noise that you see on social media. So go and check them out. We'll obviously be talking about it, but not nearly in the depth that they will be there.
So Ren, at the top, you teased that in this segment, we are going to learn how to analyze any stock in 30 seconds.
Yes. Now,
I can do that.
All right, go.
Gut
Qantas.
feel. No.
Zip.
Yes.
Okay, so aside from that, I came across this video on social media so let's listen to it and then unpack it, and then we'll go from there.
Okay.
Banks want to keep investing complicated, so you keep depending on their support. But the truth is that after investing for a decade, I know it takes just 30 seconds to analyze any stock. Basically, you want to always check these 4 numbers. EV/EBITDA ratio, it must be below 20, and it tells us how much expensive is the stock price compared to how much money the company makes. Amazon has a 19 ratio, AMD 70, so it's not good. Then, you want to check the gross margin to be over 50%. If I sell a phone for $100 and it costs me $40 to make, my gross margin is 60%. Nvidia has a 76% gross margin. Price, free cash flow must be below 20. This shows us how efficient the company is in generating actual cash. Like, would you buy a company that makes 1 billion in revenues, but just has $0 in profit? Probably not, right? And finally, you want to check the PEG ratio to be below 2. This shows us how undervalued is the stock compared to its growth potential, meaning how much money it can make in the future. Meta has a value of 1.5, while Apple 3.5.
So that's the video. 4 criteria. Let's just relist them and then we can explain
Yep.
some of the metrics. So the first one, enterprise value to EBITDA less than 20, gross margin greater than 50%, price to free cash flow less than 20, and then price earnings growth ratio of less than, or 2 or less.
Yes.
So 4 criteria, analyze any stock in 30 seconds. The good news is, to jump ahead, we've done the work and screened globally and in Australia for these stocks. So we'll talk to that. But before then, let's explain the criteria. And maybe even before then, what do you think just generally of this as a framework?
I mean, it's interesting. It seems like it's got some substance to it. Everything he explained there from a ratio point of view makes sense. Like, you want companies that are efficient, that are generating profit, that have decent margins. Like, all of those things go into a good company. Whether or not whether or not you could back test this and it actually translates to a good investing strategy is another thing.
Yeah. Yeah, I think all of these criteria, like, people will give you like the 7 stock checklist, or like the 7 factor checklist, or this is a 4 factor checklist. It's like, they're always incomplete. They're never perfect. And so whenever I come across them, it's always like, okay, this can be a starting point to screen out companies and then have a more condensed list to research.
Yeah.
Essentially, what these are trying to do is, to your point, find companies with good unit economics, like high gross margins, that are growing, and that's the price earnings growth ratio.
Yeah.
So good economics, growing, and then you can
Profitable.
buy cheap.
Yeah.
Well, yeah, and profitable. Yeah, well,
Yeah.
that's good economics, I guess.
True.
So yeah, good economics and profitable, growing, and you buy cheap. And
Yeah.
this is really just a way to screen those out. To quickly explain some of the criteria.
Yep.
So enterprise value to EBITDA is like a twist on a price to earnings ratio.
Yeah.
Enterprise value factors in a company's cash on their balance sheet or the amount of debt they have. So it's a little bit different to market cap. And then EBITDA is a version of profit that takes out a few cost lines and tries to more closely equate to cash flow.
Yeah.
But think of it as like price to earnings with a twist.
So in this instance, he wants enterprise value to be less than 20 times EBITDA.
Yeah. Second one is gross margins. So if you think about a company's income statement, they'll have revenue at the top, how much money they make from sales. Then there's gross profit, which is revenue less cost of producing that revenue. So if we make computers and we sell $1 billion worth of computers and it costs us $400 million to make those computers, then our gross profit is $600 million, or we have a 60% gross margin.
Yeah.
And then under that, then you have all of our business costs, salaries, marketing, blah, 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 that don't actually involve making the computers. And then you get your net profit margin.
Yes.
And so he's looking at gross margin and he wants it to be greater than 50%.
Yes.
So that's the second criteria. Third criteria, price to free cash flow.
Yes. Price being market cap
Or share price. Yeah.
or share price.
Yeah.
Again, same thing, less than 20 times your free cash flow number.
Yeah, to be honest, this is very similar. 1 and 3 are very similar.
Yeah.
They're both twists on
Valuation. Really.
price to earnings.
Yeah.
Yeah. Enterprise value to EBITDA also factors in a company's debt as
Yeah.
well. So that will screen out some companies that have a heap of debt.
Yeah.
Yeah, because you add that debt back on to get enterprise value.
Yeah. I think the way he explained it was good, though. It's like, this shows if a company's making a shitload of revenue, are they actually profitable? Are they actually making money?
Yes. Yeah. And then finally, price earnings growth ratio. It's a bit of a different ratio. It takes price to earnings and then factors in how fast a company is growing. Because let's say we have 2 companies that both have price to earnings ratios of 15, then that doesn't mean they're both the same value. let's say I have a company that's growing at 5% a year and you have a company that's growing at 15% a year. Obviously, if they're both trading at 15 times PE, yours is a better investment because you're growing faster. But you can't see that from the PE.
No.
So you take the price to earnings and you divide it by the annual earnings per share growth rate. So I'm growing at 5%, 15 divided by 5, my PEG is 3. Yours 15 divided by 15%, so your PEG is 1. So once we factor in growth, we might have the same price to earnings, but because you're growing faster, you get a lower score. It's like golf, lower is better here.
Yes. Yeah. Now I get it. It's just saying your price to earnings is 1 times your growth rate. If it's 1. Or if it's 3, it's your price to earnings is 3 times your growth rate.
Yeah. That's the other way of doing
so
it.
So 2 in this instance is saying your price to earnings is 2 times your growth rate.
Yeah. So if your price to earnings is 50, you have to be growing at least 25% a
Shitloads.
year.
Yeah.
So they're the 4 criteria.
Yeah.
Okay, now let's get to the interesting thing. And this is why I originally looked at it. I was like, do these companies exist?
Yes.
Yeah.
Well, do they?
They do. So do you want to start with Australia or the world?
Let's go Australia.
Okay,
Yeah.
so the good news is they do exist. I've got a list here from Guru Focus,
Okay.
which is one of the stock screeners that had all those metrics in there. So starting from biggest market cap and just working the way down. Rio Tinto fits the
Okay.
bill. Fortescue fits the bill. Premier Investments,
Wow.
Solomon Lew's retailer,
yeah.
fits the bill.
Yeah.
A couple more mining companies, Perseus Mining and Stanmore Resources. Accent Group, another retailer. Nick Scali Furniture, another retailer, yeah. Collins Food, the big KFC franchisee.
Yep.
Yeah.
Yep.
And then it goes down from there. A couple of other names, Beacon Lighting Group, LaserBond is in there, and then a few other companies that are a bit smaller and that I'm not super familiar with. So, yeah, a few Aussie companies fit the bill.
I mean, the question becomes, what are the metrics, like what are the key metrics driving that? Because like some of these are operating near all-time highs.
Well, they're growing.
Yeah.
Yeah.
Nice.
Okay, and then
What about US or global?
global.
Yeah.
So this is again sorted by market cap. So some pretty familiar names here. Largest company in the world that fits that criteria.
Did you actually get a sense of how many total there are when you did global?
247 globally.
247.
Yeah.
Wow. So not a lot in
Yeah.
the grand scheme of things.
And to be honest, it's less than that because the way that Guru Focus works is if a company is dual listed, it'll be listed twice.
Okay.
So for example,
Rio,
Rio
yeah.
Tinto is listed twice in this
Yeah,
list.
yeah.
Largest company in the world that fits this bill, Tencent Holdings,
Oh,
the
wow.
Chinese internet giant.
Wow.
To work through the
Yeah. What are the numbers?
so price first was EV to EBITDA, it's 13. Gross margin 51%, just sneaks over that. Price to free cash flow 14.8,
Okay.
and then PEG 1.4.
So Tencent, any other notable names globally?
Yeah, so working down the list, Qualcomm, the semiconductor company.
Yeah.
Third place, Deutsche Telekom, which people may not think they're familiar with. It's the German
Yeah.
telco. Also owns T-Mobile in the US.
Oh, there you go.
Yeah. Then Rio, Christian Dior, the luxury brand. HCA Healthcare, big US player. One of the best performing stocks despite being in a tough industry that isn't going to exist for much longer, you would think. The cigarette brand, Altria Group.
Oh, really?
Yeah. They're in there. Few other interesting names. BAE Systems, Vici Properties, the Las Vegas Property Trust that was part of that Caesars Palace split.
Yep.
Keurig, the luxury brand over in Europe. Zoom Video Communications, they fit the bill. There's a few more. Moncler, the luxury brand, also in there. Rent to Kill.
Oh, yeah.
You probably remember them from your Woolies days. Yeah. So yeah, a few interesting names in there.
Yeah, good little framework. I think as we go through this and I'm thinking it through, I think, you know, what you said around this being a way to create a universe is the way that you should look at this, because I'm even thinking like you'd plug these numbers in, and I reckon you do the next quarter, you plug it in, and there's going to be
definitely
change.
it
You
would
plug it in
change.
again,
Yeah,
it
yeah,
changes. So it'd be like, historically, how have these companies gone? Otherwise, you're taking a super active approach to trying to build a portfolio.
Especially these mining companies. Like there would be times when those ratios blow out the complete other way, just because of they get expensive, and then the iron ore price tanks, and they move in cycles.
Yeah.
Well, there are times when they're just not growing.
Yeah.
Because the iron ore price is falling.
Yeah.
And then Fortescue and Rio would fall off this list. But anyway, I think my conclusion is so much for being able to analyze any stock in 30 seconds, because I reckon this segment's taken well over 10 minutes.
Very true. But look, would love to hear what you think of the 4 key, I guess, ratios that go into analyzing a stock in 30 seconds. Come and join us in the Facebook discussion group. If you want to see the video, head over to YouTube, where we'll be embedding it into the episode over there.
This is Pimp My Portfolio. Pimp My Portfolio.
If you've just joined us, Pimp My Portfolio is a segment where we bring in an expert to review a community member's portfolio. And our expert today is one of Australia's leading financial advisors, Charlie Viola. Charlie, welcome.
G'day, gents. How are we?
Very well. Very excited for this. Yeah. And we have on the phone community member Sinead. Sinead, how are you?
Good, thanks.
You ready for this?
Yeah.
That's good. That was wow. All right. Well, as always, Ren, take us through it. What's in Sinead's portfolio?
All right. Well, Sinead's portfolio has some ETFs, then some active managers, and some individual stocks. So starting with the 2 biggest ETFs, the BetaShares A200 and then the iShares S&P 500. Together, they make up just shy of 40% of the portfolio. Then we've got some active managers and a thematic ETF. Fidelity Global Emerging Markets, Regal Investments, Future Gen and Hearts and Minds, L1 Long Short Fund, and a VanEck Clean Energy ETF. All together, they're about 45% of the portfolio. And then the remaining portfolio is in 3 individual stocks: Adore Beauty, Cochlear, and Macquarie Group.
Wow.
So, Charlie, we like to start with a nickname. So, what have you got here?
Yeah, I reckon we call this one the good, the bad, and the ugly.
Okay.
Okay, nice.
Which I'll explain as we go.
Nice.
Okay,
all right.
all right.
Well, we'll unpack that. But Sinead, initial response to Charlie's name.
Yeah, no, I think that's great. I don't know, I was kind of nervous about that. But yeah, I think that's a very fair assumption.
And Sinead, how did this portfolio come to be? Tell us a bit about the journey.
I started out in 2020, so COVID had a lot of free time. And basically, like you alluded to, built it on a foundation of those index ETFs, managed funds. They were mostly focused on dividend stock. Basically, took direct advice from a man in finance in the growth environment of COVID. I've actually never seen my portfolio in the green. So
no.
There's the bad and the ugly.
Oh, no.
Well, hopefully after today we can set you on the right course.
This might be a therapy session.
All right, so Charlie, that's the challenge. Never seen the portfolio in the green. So what are some of the steps we can take to start getting there?
Yeah, stop talking to whoever it was that you were talking to. might be a start. Let me start with the good, right?
Yeah.
And, your dollar cost averaging into those kind of the A200, so the ASX 200 ETF, and the IHVV, which is the S&P 500. They're the right ones to be putting the money into, and your biggest exposures are that A200, IHVV, and L1, which are all the right ones. I reckon that's probably where the good stops, though.
Okay.
If I'm honest, when I look through this, there's just no sort of sense of direction. I feel like you've been told what to buy or what was cool on social media. It's almost like you've sort of been either late to the party, and it's almost one of the reasons why we're not massive fans of thematic investing, because there's some proper rubbish in here, if I'm really honest. And the easiest way that we would kind of deal with this is it's a little bit like cleaning up the living room after you've had a big party. Like, the only thing that should be left behind is like the table and the lounge. All the other rubbish, throw it away.
Okay.
Right? So I'd basically kill all of it at this point and just keep a really simple pot of the A200, IHVV, the L1, Macquarie and Cochlear, and then just keep it really simple and keep allocating to that A200 and IHVV. And I think what you'll find is, by the power of the kind of dollar cost averaging and the fact that you've got those good broad-based exposures, and a good manager in L1 and a good quality company in Macquarie, you'll probably start to see it go green over a period of time. All this other stuff in terms of the kind of thematics where you've tried to take exposures to in clean energy and Adore Beauty and Hearts and Mind, which is like a mush up of people's best ideas that may well come off kind of thing. It's just not the way to kind of construct a portfolio. You need asset quality, diversity, and then like a really simple plan is kind of my view.
Sinead, what are your thoughts around that? Is this where you're thinking at? Is that like clear out what's not working, or where was your head at?
Yeah, no, for sure. I think that is definitely the tough love I was looking for. I haven't sold anything. I'm just clinging on to the fact that maybe eventually it'll go up. But yeah, I think it's interesting that Hearts and Minds one, because it is quite FGG, a big dividend, gives out a big dividend, but obviously it's not like a growth stock. So I guess you're kind of more inclined to look at those growth stocks in the end.
Yeah, I think the answer to that is we're more inclined to look at good broad-based exposures where you're just getting access to the whole of the market. With reasonably small portfolios, you can make the mistake of trying to carve stuff up too thin, and you just end up with all these really kind of immaterial kind of positions. You're much better having less lines, more material positions, and greater diversity, because the purpose of these things are meant to be a bit of a savings plan. So the best way to generate the savings plan is just have those kind of good diverse exposures and just keep adding to them over a period of time. Investing's not actually meant to be a wild ride. It's meant to be like this kind of smooth, this smooth cruise. And the way to do that is broad-based exposures. This may well end up as the kind of wild ride. It's kind of not what you want. Get your thrills in life in other parts of your life, not your investing sort of thing.
And so for Sinead, and I guess many other people listening in a position like this, Charlie, where your portfolio is full of losses, how do you overcome that feeling of when is the right time? I'm hanging on for that Adore Beauty to get back to the IPO price, or the HM1 to get back. When's the right time?
Historically, you can go back and do this over, every good manager and every good investment manager will tell you, cut your losses, you know what I mean? Yeah, absolutely. Chase momentum, chase your winners completely, because there's obviously a reason why they're winning. But yeah, cut your losses and contribute monies, especially for small portfolios where you're putting money in every month. And like I said, there is some good stuff in here, right? The vast majority of the money is invested in that A200, IHVV and LSF. That makes up 60% of the portfolio. That's where you should be concentrating. And if you had just done those things, you would have seen nothing but green. You would have seen an IRR of 20% or something, right? So, cut the losses,
so
invest in good stuff.
The grass is greener on the other side.
Yeah, I think Sinead,
unless you invest in clean energy stock, not so much.
I think you look at, as Charlie said, the three, the A200, IHVV, the L1 long short, Cochlear and Macquarie. Those are the 5 things that you said were great. And together they're 2/3 of your portfolio. So it's probably a lesson that we can all take away, that less is more. And it's certainly something that, Charlie, you've said on the show before, and Bryce repeats every time he talks about his portfolio, that he went through this exercise of really consolidating the amount of lines on his portfolio and just really sticking to good high quality stuff. And I think if you want to see green in your portfolio, that's probably a good first step to take.
Yeah, the old KISS principle, keep it simple, Sinead.
Nice. Nailed that.
Yeah, just keep it simple. Take out the trash and just keep polishing the kind of coffee table, I reckon. Just keep putting the good stuff in, and I think it'll be fine. And then I think you'll feel a lot better about your investment journey as well, because you'll be starting to see the fruits of that kind of money that you're putting in every month.
And whoever that man in finance is who's giving you all those stock tips, tell him to
Tell him to pipe it.
yeah.
Yeah, look, got the foundation to do my own due diligence now. So
Nice.
that's
Yeah,
thank
that's
you.
it. That's it.
Well, Sinead, were there any final questions or thoughts you had?
No, thanks so much for your time. Really appreciate it.
No worries. Well, thank you for submitting. I know it's it can be a bit nerve-wracking putting your portfolio up and in front of an expert, but we really appreciate it. And as always, Charlie, we appreciate you sharing your thoughts with Sinead as well.
Cheers. Thanks, guys.
If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. All the information is there. But Ren, we'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.